All right, let's dive straight into this explainer on Moog Inc. Class B. If you follow the industrials or aerospace sectors at all, you have probably seen the ticker MOG.B flashing green lately. Today, we're putting the sheer, almost unstoppable momentum of this stock up against a pretty harsh reality check of its underlying value. We are going to explore the incredible highs, the foundational business growth, and a valuation gap that might completely change how you view this asset.
Okay, just look at this staggering number, 623.16%. That percentage represents Moog Class B's massive 10-year total return. Now, for any investor, seeing a number like that immediately commands attention, right? I mean, it literally means an investment made a decade ago has multiplied in value more than 6 times over. It's exactly the kind of long-term momentum that puts a company squarely on the radar of every growth-focused investor out there.
And, this really isn't some short-term fluke either. We're looking at a relentless, sustained upward trajectory. We've got a 3-year return of 252.19%, a 5-year return of 285.48%, and of course, that massive 10-year return we just talked about. This is a consistent compounding effect that has pushed the stock's recent trading price to over $313 per share. The market has just been rewarding Moog with incredible enthusiasm year after year. But as we all know, a soaring stock price doesn't just happen by magic. It needs an engine. It needs real, tangible business results fueling that historic climb. We really need to peek under the hood at the income and revenue to see if the actual operational performance justifies the wild enthusiasm we're seeing on the stock chart. To accurately measure that engine, we first need to quickly touch on a metric we'll be using: compound annual growth rate, or CAGR. Basically, CAGR gives us the smoothed annualized yield of a metric over a specific block of time. It cuts through the noise. It ignores that one unusually great year or that one terrible year and just gives us the steady, underlying pace of growth. It's really the best way to measure a company's true trajectory.
So check this out. The truly explosive growth here is happening right on the bottom line. Look at that 5-year net income CAGR. It is sitting at an absolutely massive 143.55%. That means their actual profits have been compounding at an extraordinary rate. And right alongside that, we see a very steady 3-year revenue growth of 9.62%. So what does this tell us? Well, Moog isn't just selling more stuff. They are becoming insanely efficient at turning those sales into pure profit. This robust net income growth is the booming foundation that has heavily driven this stock's massive run.
Now, beyond that skyrocketing share price, let's take a quick look at the dividend drip. Basically, how Moog directly rewards the shareholders who actually hold on to the stock. So the dividend yield itself is pretty modest at 0.38%. You're definitely not buying the stock today for a massive quarterly income check. But here's the kicker. The payout ratio is incredibly safe at just 14.98%. This means they're paying out less than 15% of their earnings as dividends, which leaves a ton of cash to reinvest back into that massive growth engine we just discussed. Plus, they have a solid track record of 5 consecutive years of dividend increases. It's a reliable, highly secure, though admittedly small, dividend drip that rewards your patience. All right, here is where our story takes a bit of a twist. We are going to transition from high-flying momentum to a pretty harsh reality check. Because in investing, it's never just about what you buy, right? It's intimately tied to what you actually pay for it. So, with all this historical momentum, the crazy 10-year returns, and the explosive net income growth, we absolutely have to pause and ask this fundamental question. Are investors paying a fair price today? Or has all this market enthusiasm pushed the stock price way, way ahead of the actual value of the business? Get ready for a serious jaw-dropper drawn straight from the data. On one side, we have the recent trading price, a very hefty $313.56 per share. But on the other side, according to the discounted cash flow fair value metrics from our source data, the fundamental fair value price is calculated at just $27.88. I really want you to let that sink in for a second. The market is happily pricing this stock at over $313, while cash flow models suggest the intrinsic value is dramatically lower. To really grasp the potential danger here, we got to define an absolutely crucial investing principle: the margin of safety. The margin of safety is simply the difference between the intrinsic fundamental value of a stock and its current market price. Basically, you want to buy stocks with a large positive margin of safety. That means you're buying it for less than it's truly worth, which gives you a cushion or room for error if things suddenly go south. And yeah, that brings us to this extremely alarming number.
A massive negative margin of safety of negative 1,024.85%. This metric alone shows us exactly how far the share price has outpaced the actual intrinsic value calculations. A negative margin of safety this large implies that, at current prices, investors have absolutely zero cushion, none. They're paying a massive premium for future expectations rather than current tangible value.
Just look at how hot this stock is running compared to its own historical track record. The current price-to-earnings ratio sits at 38.47, which is well above its 3-year average of 30.08. The price-to-sales ratio is at 2.42 against an average of 1.73, and the price-to-book ratio is way up to 5.08 compared to its usual 3.97. Across the board, earnings, sales, and book value, investors today are paying significantly more for the exact same metrics than they were on average over the last 3 years. The market is literally pricing in absolute perfection right now.
Now, to be completely fair and impartial here, it's vital we look at the whole picture. Despite the steep premium on the shares and those flashing red alert valuation multiples, the company itself is actually fundamentally sound. They are not over-leveraged at all. Moog holds a very stable debt-to-equity ratio of just 0.58. This tells us they are relying much more on their own equity than on borrowed money to finance their operations. So while the stock itself might be priced incredibly aggressively, the underlying corporate balance sheet remains remarkably healthy and low risk. So bringing all of these wildly diverse metrics together gives us two distinct, almost entirely contradictory realities about Moog stock. It is a fascinating explainer of what happens when a genuinely great underlying business gets swept up in incredible market momentum. It's a total Jekyll and Hyde dynamic, perfectly illustrated right here. The bull case is completely undeniable, skyrocketing historical returns of over 600% in a decade, fueled by real, tangible net income growth of over 140% across the last 5 years, all backed up by a rock-solid balance sheet. But fiercely battling against that is the bear case, extreme valuation multiples, a stock trading far, far above its historical averages, and a massive negative margin of safety when looking at discounted cash flows.
Which leaves us with a classic, timeless investing dilemma to wrap up today's explainer. When you are faced with this exact set of numbers, what kind of investor are you? Are you going to pay a hefty premium to ride the wave of a proven, momentum-driven growth engine, or do you stay safely on the sidelines waiting for the price to drop back down to reality? There is no single right answer, for sure, but understanding these numbers is the absolute key to making an informed choice. Keep digging into the data, keep questioning the momentum, and I will see you in our next explainer.